Hello there. Good evening. Welcome to the Jim Bohannon Show from Westwood One Radio. We're at 1-866-50-JIMBO, 1-866-505-4626. Online, you can find us at jimbotalk.net. Ready to make some money? I know for many of you that is a cruel joke. Make money? Are you kidding me? I'm losing my shirt. I've lost my job. I'm into a terrible substandard job and consider myself lucky my neighbor is just flat out of work. My business went under, et cetera, et cetera. The tales are legion. And despite the fact that there have been some signs of an economic upturn, for a lot of people that sign is not too prevalent. However, having said that, our guest tonight believes that this is, in fact, a pretty good time for a good many of you to make a really serious amount of money. And I would point out as I introduce our guest, you check on some of the fortunes that exist in this country and find out how many of them were made between 1929 and, say, 1935. When the country was wallowing in the Great Depression, more than a few people, instead of hunkering in the bunker, said to themselves, this is an opportunity. And these are perilous times, and you got to be careful where you go tap dancing through the minefield. But if you play it right and you play it smart, then a lot of wealth could be at your disposal. We'll use that as an introduction to our guest tonight. We talk tonight to Jack Garson, founder of Garson Claxton, LLC. He is a business advisor and author, and he has written How to Build a Business and Sell It for Millions, published by St. Martin's Press. Good to have you on the program tonight.
Thanks so much. I'm delighted to be here.
For a lot of people, again, as I say, they're sitting out there in economic misery, and this is like a cruel joke. Oh, yeah, I'm going to build a business, and then I'm going to sell it for millions. But you are talking to a lot of people. Now, how many people are you talking to who, for them, it really is a cruel joke? I mean, everybody couldn't do this, could they?
Well, the point you made a moment ago is an excellent point. Some of the most famous, successful businesses were started in times of great economic distress. IBM, Disney, General Electric, Hewlett-Packard were all started during depressions, economic panics, or severe recessions. It's not a question of whether or not it's a time of economic distress. It's more a question of, do you have a good business? If you have a good business, it can be a great time to jump in.
Although, of course, it goes, I think, back to the old axiom, buy low, sell high, and there's no better time to be buying in low than when everything is depressed in price, and that even magnifies further that good idea.
Well, certainly, and that's one of the things that I'm counseling people on right now, is that we have gone through a time period of economic distress that has suppressed the prices that businesses are being sold at, and people are buying businesses for tremendous bargains. In 3 to 5 years, the professional buyers of businesses are going to be flipping those businesses for 5 to 10 times what they're buying them for today, leading to tremendous profits. And then what they're going to do is they're going to announce their tremendous results to draw in greater investors and acclaim. And that's going to attract all kinds of people, college funds, pension funds, private equity firms, to this asset class. So setting up a business today is saying, I want to converge with that tremendous selling opportunity down the road.
And which is interesting, because that's part of the entire process here. We're not talking about somebody who says, I have always wanted to make widgets, and by golly, we're going to start the Bohannon widget factory, and who knows, maybe someday my great-grandchildren will carry on the Bohannon widget tradition. You're talking about somebody who plans to start making widgets with the express purpose of getting rid of it.
Absolutely.
Of building it up big and selling it off, and as you put it in here, planning to sell. That's the whole point. Right. You're not starting a business under this scenario to have it. You're starting a business to sell it.
If you build a business that will sell, you can always keep it. You've just built a better business, because a business that can sell is more valuable.
Do you plan differently? If we have two people, let's say, one wants to build the family widget fortune, and the other wants to build a quick widget business that they can sell off, would they do things any differently? I would think in both cases you're looking for a good return on investment. You're looking to keep control of expenses and all the standard business 101 things. So is there really any difference at all to planning on doing this or not?
Well, certainly there are critical differences. I'll give you an example. example. I have two gentlemen I've worked with for years. They set up a very profitable business, and they received an offer to sell the company. And when they received the offer, they went to their accountant and found out the tax bill would be enormous because instead of setting it up properly, they chose a C corporation instead of an S corporation or an LLC, and they would have paid more than 50% of the sales price in taxes, essentially because they checked the wrong box. So
lead us by the hand here, because
certainly.
I mean, you're off in the areas here, but I can nod knowingly, but it's a big front. I wouldn't know a C from an S from an ASS corporation.
Certainly.
I don't know what these things. I understand that there are some tax differences here, and you might pick one over the other, but I don't know why.
Right. Well, there are a variety of different entities that form the house for your business, and they give you certain attributes. Mm-hmm. C Corporation is one of the most classic traditional ones, and it gives you a lot of protection if people are going to be suing you. If you're in a high-risk business, you might pick a C Corporation. An S Corporation is the same thing, except it has more advantageous tax aspects. An LLC is a limited liability company, and it combines the best of both worlds. That strong protection from liability and the one layer of taxation instead of two layers of taxation. Let me break that down just a touch. If you go to sell your business, you're typically selling the assets of the business, not the stock, because the buyer doesn't want to take over the whole kit and caboodle and all of your liabilities. They want the assets and no more, so they lower their risk. When they buy those assets, your corporation will pay taxes on the gain if you have a corporation.
That would be a capital gain?
It would be a variety of complicated gains that your accountant would help you work out that I couldn't do justice to right here.
Fair enough.
And then you would distribute the profits to the shareholders in a dividend, and that would be taxed again. Whereas an LLC says we're going to have one layer of taxation, and it's going to reduce the amount of taxes you pay. And that's the very type of thing that you would do differently if you were going to go ahead and set up a business to sell it, as opposed to a lifestyle business that you're just keeping around to maintain your lifestyle.
Now, if you, in fact, are someone wanting to take over someone else's assets, like in this case, this microphone, this desk, these chairs,
right.
Wouldn't you also would you count cash flow as one of the assets? Because let's face it, we're not just here to stick microphones on tables. We're here to make money from our commercials, and presumably, I would guess you would call it an asset. That cash flow is the only thing we've really got, right?
Well, technically,
unless it's a fire sale.
In the technical parlance, the cash in the till is an asset. The cash flow is a financial attribute of the business.
Which is to say what you can reasonably expect to make. We've been making $100 a week, and we can therefore expect to continue making $100 a week or whatever it is we're making.
And you're exactly correct. Most professionals who buy businesses use the following formula. They pay a multiple of EBITDA, earnings before interest, taxes, depreciation, and amortization. It's like a net income formula. And so that's what they're looking at, and they might pay 5 times EBITDA or 10 times EBITDA or even more.
Now, you write here that buyers look for a lot of things. Here are some of the very top of the list. They look for, one, profitability, a business that consistently makes money. Ideally, your profits increase every year. Would that also include relative profitability, which is to say that if in a very down period, if the market I'm in is down 13%, but I'm only down 7%, that relatively speaking, I'm more profitable?
I was told you really know your stuff. That's exactly correct. That's very important, because when you're comparing businesses within an industry, a more sophisticated analysis is not merely the profitability, but how you're doing compared to your competitors. So you're absolutely correct.
And also competitive edge, a business that beats the competition. It seems like in an awful lot of areas of endeavor, there isn't that much of a competitive edge. It's not as though you really have the better mousetrap to market. What you have is maybe a slightly different mousetrap, and maybe it's got a better paint job, and you've got a really catchy slogan. But if you get right down to mousetraps, it's not that much different. How often do you come across somebody who really has a genuine competitive edge? I mean, is Hertz really that much better than Avis, or is Chevy that much better than Ford, really?
Well, you're absolutely correct, but a competitive edge is a critical component to really drive the value you want from your business. And it could be a variety of things. It could just be incredible customer service that you give, or it could be a patent or a trademark or a trade secret. We had one client who provided environmental remediation. He cleaned up toxic waste sites with a special patented process. Nobody could duplicate the process, and it was cheaper than his competitors. That gave him a tremendous competitive edge.
We're going to come back and take a look at a few other things that buyers would be looking for as you contemplate the real possibility that you might be able to do what is suggested in this new book, How to Build a Business and Sell It for Millions. That's in big red letters on the cover of the book. Jack Garson is our guest, and St. Martin's Press is the publisher. We're at 1-866-50-JIMBO, 1-866-505-4626. Go ahead. Indulge your fantasies, but just by some reasonable expectations. We'll be back in just a moment. All right. It's tough to think of big dreams when, in fact, they've been shattered all around you, but sometimes that's the ideal time. When you have nothing to lose, you might as well think big. How to Build a Business and Sell It for Millions is published by St. Martin's Press, written by our guest, Jack Garson, founder of Garson Claxton LLC. That's your limited liability corporation that you heard about a moment ago. He's a leader of his firm's business group and serves often as a lead negotiator in some multi-million-dollar sales of companies. Now, we were talking about things that buyers are looking for in companies, and we discussed profitability and competitive edge. Also, there's something here called scalability. Don't know the term. What is that? Scalability.
Scalability is your ability to grow your business. Nobody's going to want to buy your business for $10 million and have it never grow beyond that. They'd rather buy bonds and keep their money safe. They want to know they can build their business bigger than that. So in every decision you make, you need to build into it scalability or the ability to grow your business. You don't want to buy a phone system where only 10 people can answer the phones, or a small storefront that you grow out of in a couple years. You need to build something that will grow with the success of your business. One of those things that starts with is having an executive team, infrastructure, the ability to borrow money, and also even overcoming what I call the founder's dilemma, the very limitations of the founder of the business.
Fair enough. All right. And then finally, you mentioned sustainability.
Sustainability is your ability to get through difficult times. And this is one of the classic things that torpedoes businesses. 1 out of 3 businesses will fail within 3 years because they run out of cash. So you need to start with enough money to get past your launch period until you achieve consistent profitability. You may need a variety of other things to get through tough times. It might be backup computers. It might be insurance. It might be just persistence, getting out of bed every day and going to work and going through the tough times.
How much money are we talking about when we talk about enough capitalization? And how many startup businesses fail not because the person starting it didn't know how to do whatever it is they do, or even know how to figure out that you're making enough money off of each unit to actually make money. And you'd be amazed how many people start companies that they make widgets and sell them for $1 a piece, and only after it collapses do they realize that they were paying $1.12 to make each widget. But that is another issue entirely. In how many cases here are we talking about businesses that start up that just aren't capitalized? Again, if a disaster occurs, a fire and you're not insured or whatever, how much do you really need in terms of backup? Because that could stop a lot of people from realizing dreams.
It is the number one reason for failure. You're absolutely correct. And most people just don't go through the rigorous analysis. This is where dreams clash with reality. I'm sorry?
Or know how?
Well, I detail in the book the exact procedure for doing it. You need to go ahead and plan out what your revenues and expenses are going to be, and then calculate the deficit that you're going to have until you're safely in profitability. Then, depending on how risky your business is, you want to add 10 to 30% as a cushion to create that buffer so you start with enough capital.
What about people who already own businesses and they didn't start out to make it just so they could turn it around to sell it, but they suddenly think, maybe I've stumbled on something, or more likely, they get an offer, and they think, gee whiz, I never thought this thing could be worth that much, and they're very tempted. Do the same rules for building one to sell it apply to people who stumble into selling it?
Well, a little bit of both. There's some things they need to do to fix their businesses, and then there's a whole bunch that I described in the second half of the book about the proper way to sell the business. But every business can be improved, and especially with an eye towards being able to sell it, because buyers are looking for very specific things.
Okay. What about marketing a business for sale? In other words, okay, I've made it. I'm going to sell it. I mean, what do I just do? Put it on eBay? I mean, I don't know what I put a sign in the front yard for sale. That's got to cover a lot of ground, I'm sure. But in particularly the 21st century, what's the manner in which you actually say it's available?
Well, it's a great question because you're not going to market your company for sale. The job of the entrepreneur is to build a great company and then to assemble a good team, and they're going to sell it. That team is typically an investment banker, the really critical person in marketing your company for sale, your legal advisors and your financial advisors. That's your external team, and then you'll have an internal team as well.
Does the mere fact that you're making it available wave a red flag in the eyes of some people? Hey, looks like Mr. Garson's got a pretty good thing going here, making great widgets and all. Why does he want to sell? Is that a red flag for them to say, if he wants to get rid of it, why should I want to buy it?
Many people are extremely cautious about that very point, and there's often a confidential offering process where certain facts about the company, including their financial statements, are revealed without identifying information to qualified people who sign confidentiality agreements, and only then is the identity of the company revealed. Interesting.
So you go through these investment bankers. They're just third parties who... obviously, they're not third parties as a hobby. They get paid. What do you gain in exchange for cutting into the amount of money you make on the sale by using these investment bankers?
Well, first thing, as it relates to businesses, they're the ultimate salespeople. They could sell stands at the beach. These are the people who know how to find the right buyers and negotiate the right terms and get deals done.
Okay.
Now, certainly they need the legal and financial support, but they're the glorified business broker. Business brokers are what you use in a sale anywhere from $1 to $10 million. An investment banker is what you would use in a sale of a business, usually from $10 million and above.
Okay.
And it's someone who's got the PhD in selling.
Right. Who pays the commission on this? Is it typically the person selling the business or the person buying the business? Because it may well be, as you say, that if I use one of these bankers, I'm going to make far more using them than I'd ever make without them.
You're typically going to pay a commission that's based on a percentage of the sales price, in addition to often a monthly consulting fee or a lump sum consulting fee, and reimbursement of out-of-pocket expenses.
So what are we talking about, 8%, 10%?
Well, I'm working on one deal right now where if the company sells for $20 million, the commission will be approximately $1 million.
So about 5%, okay.
But it's a sliding scale, and it goes up and down with the gross.
More to come with our guest, Jack Garson, and we'll be back here at Westwood One. Welcome back. This is the Jim Bohannon Show. We're talking tonight about how to build a business and sell it for millions. And it seems preposterous to a few of you. I suspect more than a few of you may actually be saying, maybe I could do that. Jack Garson, our guest, is the founder of Garson Claxton LLC. He's the author of How to Build a Business and Sell It for Millions. So we're talking here about some of the strategies. And let's talk a bit about the realistic expectations. How much of your own money would you say you would need to do what the book title suggests, build a business and sell it for millions, in an era of tight credit? How much of your own dough should you have available to actually write a check and make it so?
Well, it'll depend on every business, but you point out something that's very prevalent today. It's extremely difficult to get bank financing. And in fact, unless you've done a number of startup businesses that have succeeded and been sold, you're very unlikely to get bank financing.
Yeah.
And I also caution people that you should go to family and friends and ask them for money like you would an organ, very cautiously. The downside of losing your parents' retirement money should be obvious.
Yeah.
So you do need to be conservative in your raising of the funds. Savings is the best way to go. If you can save the money and put it into the business and start small, that's probably the best way to go.
No.
Now, there is a substitute, and one of those substitutes is starting with business. If you're working for a company that really values your services and you're ready to leave, there are plenty of situations I've seen where they've retained that person as a consultant, and the check from that consulting fee covers their nut. It pays their overhead, and that gives them a replacement for the startup capital. Or they start with a few customers, and the customers commit, maybe for a discount, to give them business for their first year in business, and again, they can meet their monthly nut. So those are good substitutes in addition to savings.
All right. Now then, for those who have started their business, okay, I'm going to build a business, and I'm going to sell it for millions, but I'm not there yet. I'm underway.
Mm-hmm.
Can they then say, okay, we're just going to run this business without regard to selling it, because I'm not going to be ready to sell this for probably 5 or 10 years, and so I don't have to worry about any decision I make being made strictly based on its ultimately being sold, that I can just run it like a business? Or should they, in fact, if they have as the ultimate goal to sell it, should every decision they make be based on getting rid of it?
Every decision should be based on the sellability of the business, because it influences so many things. I'll give you the example of the Bob Show. True client, had a great business, getting ready to sell the company, but he had ignored, I was on his advisory board, he ignored our advice for years. He had no other executives. He had no sophisticated financial accounting system. He had no CFO for the company. And when the buyers came in and did their due diligence, they were scared off by the fact that if Bob got hit by a bus, there was no company, and it killed the deal. So, chastened by that event, he listened to our advice. He hired a president from a Fortune 100 company. He hired a CFO from what was then a Big Six accounting firm. He put in a sophisticated financial accounting system. We then got things geared up over a year. And the next thing we knew, we hired our investment banker and we conducted an auction and sold the business for more money than he ever would have dreamed of. But we never would have achieved that if we hadn't put in all of the things that were desirable for a prospective buyer.
What about other aspects here? Labor contracts, benefits and the like. If you, back in the day when this was actually done, but let's say you offered the best pay in your industry and the best benefits, but on the other hand, you got the creme de la creme of the workforce, and the workforce was really important in this particular business. On the other hand, that kind of labor overhead, as loyal employees are today dubbed, that can be sometimes a real turnoff to a potential buyer. So should you shun attracting valuable but expensive things like a high-end workforce?
I actually counsel that you can't spend too much money on the right people. The right person will pay for themselves many times over. I work closely with hundreds of businesses and have for 25 years, and I've seen the people who spend too little on people. Businesses are made of people primarily, and if you don't have quality, you won't produce quality. If you overpay, then get rid of the person. But if you haven't overpaid and this person is truly valuable, they'll produce tremendous dividends. And the bottom line is the bottom line when you go to sell a business. The buyer doesn't care so much what the labor costs if you're producing outsized profits.
What about inventory? I mean, you might say, well, I'm going to keep this forever, so so I like to have lots of inventory on hand. But maybe if a prospective buyer is going to be paying for that big warehouse out there, maybe I shouldn't have so much inventory. Is that a factor also?
Certainly. Now, I very much agree with that. If you are sitting on stale inventory, if you are tying up capital in something that's not producing a return on investment, that's going to hurt you with the buyer. And they're not even going to want to buy that inventory. When they go to buy, they're going to say, we only need half the stuff in there. Don't sell us your old merchandise. I've heard that many times.
Interesting. All right. Let's talk a bit about We have a section here called Savvy Substitutes, and I'll just quote some from the book, How to Build a Business and Sell It for Millions. Here on page 37, it is possible to start small and without much cash to build a business from scratch and to make it sustainable. One of my clients did it perfectly. His plan was to sell vitamins and supplements. He started by buying a mailing list from a similar company that was going out of business. Customers slowly started ordering his products through the mail. When he had saved enough money, he rented a warehouse that was so out of the way, I could have given you perfect directions and you still wouldn't find it. But the location became part of its charm. You were considered hip if you could find it, like some L.A. hole-in-the-wall bar. My client worked hard, didn't waste a penny, even brought in his mom to help for free. He built up a great selection and specialized in natural supplements. Prices were low, staff was knowledgeable, and he would special order anything you wanted. And eventually, he came up with catchy advertising that brought in crowds. Working slowly and modestly, he expanded, but always by renting cheap space in edgy neighborhoods that other retailers overlooked. So I guess that would be a perfect example of someone who didn't have a lot of investment resources, but who was very smart in taking advantage of things that could be used to grow without having the cash up front.
That's absolutely right. I met him. I was one of his biggest customers, and then I became his attorney. And he did it the start small and save method. He did it with rubbing 2 pennies together. And he was very patient. And he was very industrious, and he did it the old-fashioned way. He worked really hard, 18-hour days, involving the whole family, and being very smart about it.
You add, it is rare, but you can also find substitutes for startup capital. In addition to starting cheap and small, I found another miracle substitute for initial capital: contracts and customers.
That's what I just mentioned a moment ago.
Exactly.
Where you start with business.
Right.
If you start with business, it substitutes for cash.
Okay, more to come here. Stay with us. I hope that you are getting inspired and perhaps even, well, if you get really rich, remember an aging hack in the twilight of a mediocre career. Adopt me, okay? When you in fact sell that business for millions, adopt me. We'll be back with more with Jack Garson after these messages. Thank you for being with us on the Jim Bohannon Show as we talk tonight with Jack Garson, the author of How to Build a Business and Sell It for Millions from St. Martin's Press. Does the term franchising fit into any of this?
It certainly does. It's probably a more limited area in that people who grow their businesses and franchise them are selling in a quite different way. You've got a good business model. Let's say you've got a pizza shop that people love, and they actually walk into your store on a regular basis and say, hey, are you franchising? Well, first rule of thumb is it probably doesn't make sense to consider franchising until you have about 10 prospects for franchises, because the legal fees are about $100,000.
Oh.
You have to register in almost every state where you do business, right, and you also have to register with the Federal Trade Commission. It's a lot of paperwork, a lot of disclosure. So you're preparing tremendous amount of financial statements and disclosures and agreements that are highly regulated. But from that point forward, you're looking at a different exit strategy. Your exit strategy is selling off, in effect, little pieces of your business at a time to the franchisees, as opposed to selling the whole kit and caboodle in a sale of the company.
What about the sale of the franchise? If I own McDonald's, let's say, and I just sell McDonald's, and therefore whatever I own, I'm not sure what McDonald's actually owns in a given McDonald's outlet, but whatever that is, I'm selling the whole thing to you. What about, do the rules in this book apply then? Because obviously you're talking about a pretty hefty business to start with if you've actually franchised something.
Now, are we talking about the entire franchise chain or your
Everything.
Particular store as a franchisee?
That's okay. Either one. That's worth exploring either way. In other words, if I were to try and sell my particular franchise, it's not technically my business.
Well, that's an excellent point. It depends on the franchise. I had a gentleman, it was in probably the late 1980s. He had bought a Pearl Vision franchise, and he wanted to sell his franchise. It was a very successful business. At the time, he was doing really good business, and it was probably worth $1 million. Late 80s, that's a lot of money. And there was a provision in the franchise agreement that said Pearl Vision could buy back his franchise at any time just by refunding his $25,000 royalty fee. That's a terrible provision. The guy didn't notice it. It was in the fine print. He never should have agreed to it. So if you're trying to build up something you can sell, you need to make sure that when you buy a franchise, you've got an agreement that will let you do so. Now, when you're the franchisor, different story.
Okay.
If you're going to build up a chain of 10, 20, 30, 50 stores, you've got something that's very valuable because what you're selling there is the royalty stream that's coming in from all of your franchisees. Right. And there are plenty of companies that have done very well selling their franchises to even bigger companies.
Okay, so the same rules apply, even although it's probably going to be on a larger scale.
Certainly.
Okay, all right. Chapter 16, contracts because a handshake won't do. That's worth exploring here. Why is that so critical? Maybe we are past the era when handshakes really can do, but there are people, I'm sure, who would say, well, handshakes won't do, except for my Uncle Fred, or except for my brother-in-law Joe, or except for... You say handshakes will never do.
Well, it's a great point because, you see, that's the difference between a lifestyle business and one you're going to sell. A lifestyle business is one that's just around and it meets your lifestyle, and you might kick off early on Fridays for golf or whatever it might be to go see the kids' soccer game. But a business that you're building to sell has to be attractive to the buyer. And when the buyer steps in, the buyer wants to know that everything that contributes to your revenues and all of your critical supplies and all of your critical agreements have been documented and they're enforceable, and when they buy the business, they get them.
Okay.
That they don't have to renegotiate or start over.
So it's not just for your protection, but everybody's protection.
That's correct. That's correct.
Well, that's fair enough. Okay. What about becoming a competition factory? You make mention of the term. I don't know what that means, but I know that you feel it's important to bring up. So let's talk about a competition factory.
There are the things that I mentioned in this book called the hard way rules. These are the rules you normally only learn the hard way, and being a competition factory is one of them. Many businesses, especially first-time entrepreneurs, implicitly trust their employees, and they don't want them to feel like they're not trusted or that they're the enemy. So they don't take certain precautions. A classic precaution is to make sure that your employees can't walk off with your business, that they can't steal your customers, steal your secret formulas, steal the way you do business. Ad agencies are a perfect example of where high-level executives are constantly leaving the company and taking half the customers with them. And as I say in the book, the third time you've been kicked in the stomach is the time when you decide, I'm tired of being a competition factory, I'm going to protect myself. So you start putting non-compete agreements in place. You start having certain programs that enhance retention of employees. You start institutionalizing your customer base by getting them to bond not just with one account executive, but working with teams of your employees so the loss of just one employee won't impact their relationship with the company.
Stay with us. We have more to come with our guest, Jack Garson, the author of How to Build a Business and Sell It for Millions. We'll be right back. Welcome back to the Jim Bohannon Show. We're learning how to build a business and sell it for millions with Jack Garson, our guest tonight, who has, in fact, been an advisor for a lot of people who've done just that. Now, we've all heard about the self-destructive boss. In fact, many of us have worked for them. Some of us may have been them. Now then, in terms of this building and selling a business, tell us about self-destructive bosses. Well,
there's two ends to the spectrum. One end is the really crazy end. We had one client who choked 4 of his employees. He gave his employees underage employees 6 packs of beer on Friday afternoons, loaded into their trucks before they hit the highway. He was that extreme example. And at the end of the day, he lost his company. He was someone who wasn't about to deal with those issues, and they were severe. But what's more normal is what I call the founder's dilemma. And that's the person who's the perfectionist, who started the company, who's available to their customers 24 hours a day, has the Bluetooth in their ear, has to do everything perfectly. And then when they go to grow their company, they can't let go. They can't delegate. They can't, even if they hire a good person, let them do their job.
You cannot change, as you put it here, from being Michael Jordan to being Phil Jackson.
Yeah, that's the key. To learn how to enjoy the successes of others instead of always being in the limelight yourself. And you'll never grow a big business if you have to hog the limelight.
What about the issue of timing? If you, in fact, build a business that can be sold for millions, are there windows of opportunity such that you can wait too long and, like fresh fruit, it becomes overripe?
Absolutely. And, in fact, what I am counseling people right now is that there is a train out there that's going to be running in 3 to 5 years that's going to be the ideal time to sell. Just like there's an ideal time to sell stocks and houses and every other asset class. It's going to be a great time to sell in 3 to 5 years.
Interesting. What's the best business idea you ever heard?
One of the best business ideas right now are people who are doing work for the government. The government is shoveling a lot of money out there, and if you're in healthcare, energy, infrastructure, if you qualify with certain disadvantaged statuses that are also especially preferred, these are great things to do. I'd also follow the demographics, because we have an aging population that's going to need health care and leisure services.
I'm thinking of drive-through elder care. I haven't worked the details out yet, but I just know that just seems to be the intersection of a lot of things there. Drive-through elder care.
Sounds like a pill dispensary.
Exactly, with an express lane for one case of rheumatism or fewer. Well, what's about the worst business idea you've ever heard?
Clearly cat TV.
Cat TV?
A couple came to me, wanted to put knobs on aquariums and sell it to cat owners as cat TV. we quickly dispensed with that one.
Although, let's face it, the pet rock took off. I mean,
it was in the pet rock genre, but I don't think it was as good.
We are in an era in which the government's getting involved in a lot of things, and you note that one, in fact, excellent business idea right now is to take advantage of all the money that Uncle Sam is shoveling out. I'm wondering if the government has become so intrusive that some of the whole background, the context of building a business and selling it for millions may be lost, either through government regulation or taxation. Is this a time in which it is less advisable to be able to do what your book suggests?
Well, I do have a chapter in there about shaping the law. It's lobbying, and I do think it's important for you to look at all the things that can improve or threaten your business and be proactive. There are people who create business models because they go out there and lobby. I have one client that went from being attacked by regulators to passing legislation in about a dozen states that fully endorse his business model. He was on the cutting edge, and sometimes when you're on the cutting edge, not everybody wants you to do it.
Yeah. You ought to write a companion book, How to Buy a Business for Millions. and I guess sell it for billions? I don't know.
That could be next.
Are there rules for buying?
Oh, certainly. One of the most important things when you're buying a business is rigorous due diligence. Because some people, when they go to sell it, and you intimated this before, why are you selling? Yeah. If it's so good, why are you selling? And when you dig deep into a lot of businesses, you find bad things. It's critical to dig deep.
All right. This is a most interesting read just by virtue of the fact that, for one thing, the anecdotes and examples are in many cases priceless, Cat TV being one. But also, quite frankly, some of you could do this right now. How to Build a Business and Sell It for Millions is published by St. Martin's Press, written by our guest Jack Garson, founder of Garson Claxton, LLC.